The author of this book says that gold and share markets are quite opposite to each other. Whenever there is a decline in share prices due to war, natural calamities, or financial crisis, the price of gold increases. That's because when the investors realize that the share prices are going to reduce, so they will sell their shares and put their money on a safe investment like gold, because they think no matter what crisis occurs, gold is the one thing that doesn't get affected, says the author. So smart investors know that whenever the price of their shares increase continuously, gold prices would be less, and so they will sell half their shares and invest it in gold. So they will earn profit whether the share prices increases or decreases. They will obviously see profit if their price increases, but even if the price decreases, the gold price will increase, and so they will get profit from the gold they invested too. This process is called hedging, that is, actions that are opposite to each other. You will incur only a small loss from this, and this same concept is used in share markets too.